Okay, imagine this. Forget clicking a mouse. Think just this deafening roar.
Right.
A trading pit, shoulder to shoulder, people yelling, flashing these complex hand signals. You can almost smell the adrenaline, the paper.
Yeah, the energy must have been incredible. That was commodity trading for generations, wasn't it?
Yeah.
Oil, metals, grains.
Exactly. Now, picture the total opposite, a silent room. Just rows of servers humming away, algorithms making split-second decisions, executing trades faster than your brain can even process.
It's night and day.
How did we even get from that pit chaos to this silent, hyperspeed world? And, what does it all mean? For the markets, for traders, for how prices even get set?
It's a huge shift. I mean, you really can't overstate how fundamentally it's changed global finance, especially commodities. It's reshaped literally everything, from placing an order to how regulators even try to keep up.
Absolutely. And that journey, that incredible transformation, that's exactly what we're diving into today. We've got a whole stack of sources here, articles, reports, you name it, tracing this path from the pit floor to the fully electronic market.
Right.
And our mission really is to unpack all this material, pull out the key insights, and get a handle on this evolution. We'll be looking particularly closely at one major player, the Intercontinental Exchange, or ICE.
Yeah, looking at ICE's story, based on these sources, it's almost like a crash course in electronic trading itself.
Right.
It gives you a pretty amazing view of how it didn't just happen, but how it was strategically built up to dominate, and what that tells us about where things might be headed.
Exactly. And this deep dive, it's really for you, the listener, to give you a solid, comprehensive picture of this incredibly complex and, frankly, fast-moving world. Yeah. So let's start unpacking. Maybe we should step back first into the old world, the pit era.
Okay, yeah. Let's revisit that pit scene you painted. It sounds almost, quaint or even fictional now, but it was absolutely real. And placing an order, well, by today's standards, it was remarkably cumbersome.
Oh, definitely. The sources lay out this whole relay race. If you wanted to trade a futures contract, you couldn't just log in. You had to pick up the phone, right? Call your broker.
That's step one. And that broker, they weren't just typing it into a screen. They then had to physically call down to the exchange floor, talking to an order clerk who was stationed somewhere near the pits.
Right, amidst all the chaos. And this clerk, trying to see through this sea of shouting traders, had to somehow signal or yell your order across to a floor broker, the actual person standing in the pit for that specific commodity.
Exactly. Using those specific hand signals or just shouting over the noise. The floor broker was the one making the trade, face-to-face or maybe shoulder-to-shoulder, in that open outcry system. They'd find someone willing to take the other side, agree on a price.
And then the information had to flow all the way back, right? Broker tells the clerk calls the original broker on the phone, and then that broker finally tells you if the trade happened and at what price.
The whole chain, in reverse.
And the time involved. One source specifically says the entire thing from your initial call to getting confirmation back took at least a couple minutes.
A couple of minutes. Which, yeah, maybe seemed okay then, but in today's markets, that's an absolute lifetime. You could miss huge moves in that time.
You really could. Now, a multi-million-dollar deal happens before you can even finish saying milliseconds. It's just, wow.
It's a stark contrast. But, the people in the pits, especially the floor brokers, they argued there was a real value to that human element. They claimed they could get better executions for their clients.
Better executions, meaning like they could nudge the price a tiny bit in your favor. Buy a fraction lower, sell a fraction higher, that kind of thing.
That was the argument, yeah. As the sources describe it, they believe that by being physically there, talking constantly, they could, quote, feel the pulse of the market.
Feel the pulse. Like they had some intuitive sense.
Kind of. They were immersed in the flow, the gossip, the sentiment, the supply-demand whispers in a way someone remote just couldn't be. They felt their experience, their relationships in the crowd, gave them an edge to maybe shave off a tick here or there for their client.
Okay, I can see the appeal of that idea, that human touch, the energy. But the sources we have also paint a more complex picture, don't they? They mention the downsides, too.
Oh, for sure. While they argued for better executions, the sources also state plainly there were many examples of poor floor broker trade executions. It wasn't foolproof. Mistakes happened. Communication breakdowns.
And maybe something a bit more systemic. One source points out that floor brokers, they had to make a living.
Right, they were running a business in that pit.
And sometimes, the source says, that happened at the expense of the retail trader. Their own need to make trades, generate commissions, could sometimes clash with getting the absolute rock bottom best price for smaller clients. A potential conflict of interest, basically.
Exactly. So you had this mix, potential upsides from market feel and human interaction, but also built-in delays, inefficiencies, and these potential conflicts. And looking at the trend, well, the sources are pretty blunt about where things went. They say the days of pit trading may be ending.
One source really doesn't mince words. It says it's only a matter of time before the pits no longer exist. The momentum behind electronic trading just became overwhelming.
Yeah, the economic and technological forces were just too strong.
It is kind of amazing, though, that a few pockets still hang on. The sources mention the London Metal Exchange, the LME. They still have some physical trading in their ring.
That's right, the LME ring is a famous example. But it's definitely the exception now, a holdout clinging to tradition, not the rule anymore.
Because the rule, the dominant force now, is the dawn of electronic trading. That's the fundamental shift we're really digging into.
And the contrast, as you said, is just staggering. Forget minutes, electronic markets. The whole process takes seconds.
Or even less, right? With high-frequency trading, we're talking microseconds. Orders zip straight from a trader's computer to the exchange's matching engine. Matched. Done.
It's almost instantaneous. And maybe the single biggest, most direct benefit that jumps out from the sources, especially for smaller players, is the cost. Commissions.
Ah, right. Brokerage commissions are significantly lower electronically compared to the pit days. That had to be huge.
Absolutely massive, especially for retail traders. Back in the pit era, commissions could eat up a big chunk of potential profits, particularly if you traded frequently. Electronic trading just slashed those costs, offering much cheaper commissions for retail traders. It wasn't just cheaper, it fundamentally changed the economics of participating for many people.
Made it accessible.
Exactly. And beyond cost, there's just the raw efficiency gain.
Yeah.
Transactions execute on a faster and more efficient basis.
Mm-hmm.
Less human error, fewer steps, fewer places for things to go wrong, and just matching a buyer and seller.
And the impact on those floor brokers. One source puts it very starkly. Electronic trading has dispatched floor traders to extinction.
It's a blunt way to say it, but it reflects the reality. The efficiency gains essentially automated their traditional role out of existence for the most part.
Now, this didn't happen overnight, did it? The sources point to earlier steps, like the NASDAQ.
Right, the NASDAQ is a key milestone mentioned. Way back in 1971, it launched as the first electronic stock market without a trading floor. No pits. It relied on these things called electronic communications networks, ECNs, basically computer systems matching buy and sell orders automatically.
So that was the early model.
Kind of the blueprint, yeah. For the fully electronic exchanges we see dominating today. And if you look at the overall impact on just the experience of investing, one source summarizes it well, saying electronic trading made markets simpler, more efficient, more affordable, and more accessible.
Simpler, more efficient, affordable, accessible, plus trades in seconds, and you get all these analytical tools right on your screen.
Yeah, a wide range of analytical features instantly available. It's a completely different universe for the user compared to calling a broker who's calling a clerk who's yelling at someone.
And that speed and accessibility, it definitely fueled certain types of trading, didn't it? The sources mentioned day trading specifically.
Yeah, buying and selling within the same day, trying to catch tiny price moves. That's become increasingly popular since electronic trading took hold.
It makes sense. You need the speed and low cost.
Exactly. One source even says it's almost impossible to day trade without using electronic trading. It's basically a prerequisite. Though, interestingly, the source does pause to ask, whether the world is better off with the rise of day trading as a widespread phenomenon. That's a whole other debate.
A fair question. And just looping back on cost for a second, for someone not day trading, someone holding positions longer term, the main difference compared to the pit might just be those lower commissions, right? Even if they lost that potential pulse feeling from a floor broker.
Yeah, for many longer-term investors or hedgers, the significant cost savings probably outweighed any perceived and maybe debatable benefit from the floor contact. The economics just shifted decisively.
Okay, so the forces pushing towards electronic were powerful. And a key player, maybe the key player in harnessing and driving this, especially in commodities, was the Intercontinental Exchange, IC.
Right. The sources really position IC's story as a kind of microcosm of the whole electronic revolution. Looking at their corporate history is like getting a primer on the evolution and future of electronic trading.
And the fact that ICE, this, relatively young electronic exchange, eventually ended up buying the New York Stock Exchange, NYSE Euronext, I mean, that speaks volumes, doesn't it? The NYSE, the symbol of the trading floor, acquired by an electronic upstart.
It really does. ICE itself wasn't founded until May 2000, so compared to exchanges with centuries of history, it's a newcomer. But it was founded by some very heavy hitters.
The sources mention shareholders representing some of the world's largest energy companies and global financial institutions. People like Vanguard, Wellington, Goldman Sachs, Morgan Stanley.
Yeah, big players in energy and finance who clearly saw inefficiencies in the way things were being done, especially in energy markets, and decided to build a better mousetrap.
And their initial mission was quite focused, wasn't it, on the energy sector?
Very focused. To transform the OTC energy markets. OTC, over the counter. That's where a lot of energy deals happen, often just phone calls between dealers, voice brokering. It was fragmented, opaque, no central price view.
Not very transparent.
Not at all. So ICE's idea was to create an around-the-clock electronic marketplace for these OTC energy products, to bring the structure, the efficiency, the transparency of an exchange model to these traditionally murky markets, offering a clear alternative to voice brokers or open outcry.
And the specific benefits they were aiming for. The sources list them out.
Yeah. Greater efficiency, lower costs, more liquidity, and improved price transparency. Those were the core advantages they believed their electronic platform offered over the old ways.
And they didn't just build organically. A huge part of their story, according to the sources, is growth through acquisition. They bought up existing exchanges.
Aggressively, especially in energy and commodities. They acquired major European futures exchanges, the ones trading key benchmarks like Brent crude oil and gas oil futures. Those became ICE Futures Europe.
And that was a big deal, right?
Huge. The sources point out that by the end of 2011, just over a decade after ICE started, ICE Futures Europe was fully electronic and handled over 50% of the entire world's trading volume in crude and refined oil futures.
Wow. Half the global market on their platform in about 10 years?
Yeah, it shows the speed of the shift. And they kept going. They bought the New York Board of Trade, think cotton, sugar, coffee. They bought Canada's big canola market. They moved into environmental markets in Europe and the U.S. by acquiring climate exchange Placis. Even a Brazilian electricity exchange called BRIX.
So constantly expanding their footprint. And the key thing was?
The key thing, as the sources note, is that many, if not all of these venues transitioned to electronic form after ICO acquired them. They weren't just collecting exchanges, they were actively migrating these diverse markets onto their core electronic trading and clearing technology, building a unified platform.
And they didn't stop at traditional commodities either, right? They moved into financial derivatives.
Correct. Specifically credit derivatives. They bought Creditex, which was an interdealer broker in that space, back in August 2008.
And crucially, clearing.
Yes. Launching major clearing services, ICE Clear Europe and ICE Clear Credit. This was helped by acquiring the Clearing Corporation, TCC, and its risk model, especially for credit default swaps, CDS. Clearing is vital, it guarantees trades, reduces risk. Bringing sophisticated clearing for complex products like CDS onto their platform was another big step in integrating fragmented markets.
So before they even made the move for the NYSE, ICE had already built this powerful integrated electronic system. They'd, as one source puts it, effectively integrated and rationalized much of the fragmented commodity markets, pushed hard into credit derivatives, and developed pretty sophisticated risk management across the board.
Yeah, they were clearly positioned as a leading proponent of electronic trading. They saw it as the tool to connect everything, energy, ags, credit, onto one efficient electronic backbone.
And then came the NYSE Euronext deal, which was more than just a merger, it felt symbolic. This upstart newcomer, only 13 years old, buying the NYSE, the largest and most important equity trading platform, the icon of the floor.
It really signaled the changing of the guard. The sources mentioned the expectations at the time, big changes expected across the whole combined company, from people to products to how different assets would be traded together.
And that little detail about the NYSE building.
Right. ICE said they'd keep the iconic building on Wall Street, but the main headquarters would be elsewhere. And one author mused about the building maybe becoming a museum or condos someday. A powerful image of how the physical floor was no longer the center of the financial universe.
So ICE's rise really mirrors and in many ways drove this electronic transformation, but this new world, while efficient, isn't without its own set of problems and complexities, is it?
Not at all. That's a crucial part of the story. The sources are clear that overall, electronic trading has too many benefits to ignore. The consolidation, the efficiency.
Like exchange consolidation and economies of scale, That's highlighted as a major plus. Merging platforms, going fully electronic, it just makes running an exchange cheaper.
And the theory, or at least the hope mentioned, is that these savings eventually get passed down to the users, the traders, hedgers, and other market participants.
We definitely saw that with commissions, as you said. That's
Yeah.
a tangible benefit, especially for retail, and maybe the main one for longer-term folks compared to the pit days.
Right. But on the flip side, the sources directly link some major issues and risks squarely to electronic trading. They talk about tremendous glitches and poor trade executions that can happen electronically, often with much bigger, faster consequences because of the speed.
And they point to specific events.
They do. The most famous is probably the May 2010 flash crash. Remember that. The Dow just plummeted nearly 1,000 points in minutes and bounced back. Chaos.
Yeah, I remember the headlines, and the source says,
The source states it very directly. Electronic trading was the cause of the flash crash. It suggests the speed, the interconnectedness, the complexity of the automated systems themselves played a key role in that sudden instability.
that's a strong statement. Any other examples?
Yes, the Knight Capital incident in August 2012 is mentioned. A software bug in their trading system unleashed a flood of erroneous orders, costing the firm over $450 million in less than an hour and basically wiping out its independence. It shows the potential for catastrophic failure in these automated systems.
And then there's the whole issue of high-frequency traders, HFTs, these ultra-fast algorithmic traders.
Right. The sources discuss how HFTs are responsible for an increasingly larger amount of volume on exchanges, trading in microseconds, holding positions for tiny fractions of a second.
Is there a number on that? Like how much volume?
One source cites a JP Morgan note from 2017 suggesting only about 10% of trading volume came from traditional discretionary traders, humans making conscious buy-sell decisions, the vast majority. Driven by algorithms, much of it HFT.
Wow, only 10% human-driven. And there are concerns about these HFTs.
Definitely. A significant concern highlighted is that many believe high-frequency traders manipulate prices much more than floor traders ever could. There's this perception, outlined in the sources, that their speed and complex, often hidden strategies might open up new ways to game the market that are harder to spot than, say, someone physically trying to corner a market in the pit.
So speed and efficiency, yes, but also new vulnerabilities, new types of risk, new questions about fairness and manipulation. It's a complex picture.
Very complex. And beyond just how trades happen, the sources also remind us about the inherent nature of commodity trading itself. Electronic trading makes it easier to access, but it doesn't change the fundamental risks of the asset class.
Good point. What do the sources say are the main pros of trading commodities?
Okay, pros mentioned include leverage, the ability to control a large position with a relatively small amount of margin, maybe 5% or 10% upfront. This means if prices move your way, you can see exponential gains on your initial investment.
Potential for big returns, then. What else?
Hedging, especially against geopolitical risk. Things like supply disruptions or political tension can cause commodity scarcity. So trading them can potentially offset losses elsewhere in a portfolio during uncertain times.
Makes sense. And diversification.
That's another key pro. Commodities often move differently from stocks and bonds. They have low or negative correlation. And they can do particularly well during periods of high inflation, acting as a potential hedge when rising costs might hurt stocks.
Okay, so leverage, hedging, diversification sounds attractive, but what are the cons mentioned, the big warnings?
High volatility. This comes up again and again. Commodity prices aren't just about simple supply and demand. They're heavily influenced by external factors like geopolitical events, natural disasters, and political situations, things that can change suddenly and dramatically.
So big price swings are normal?
Very normal. The sources quote experts saying commodities are some of the most volatile asset classes, maybe twice more volatile than stocks, and 4 times more volatile than bonds. That gives you an idea of the risk level.
Wow, twice as volatile as stocks.
Yeah. And this volatility attracts speculators, people looking for quick profits, which the sources say can actually add to the fluctuations, making prices swing even more wildly than fundamentals alone might suggest.
What about concentration?
That's mentioned too, especially regarding commodity funds. While a fund gives you exposure, the fund itself might be heavily weighted in just 1 or 2 sectors, like energy or metals. So you might not be as diversified within commodities as you think.
And the flip side of leverage.
Huge risk. Over-leverage risk. That low margin requirement means just as gains can be magnified, losses can be too. A small price move against you can wipe out your entire investment very, very quickly. The sources warn traders could lose all his or her investments.
So electronic access is easy, but the underlying market is inherently risky and leverage makes it potentially explosive. The sources offer some advice before jumping in.
They do. Things like look at trading volume. High volume can mean more volatility, but also more opportunities for short-term traders. Crucially, do a thorough risk profile analysis. Know yourself, know your tolerance for these potential swings.
Choose popular commodities.
Yeah, things like crude oil, gold, silver, natural gas, soybeans are mentioned, implying these are generally more liquid, better understood markets.
And importantly,
avoid commodities you don't understand. One source stresses you need to know and experience transactions in the commodities in the market. It's not a place for casual bets based just on easy electronic access. Deep market knowledge is essential.
which logically leads us to the huge challenge all this presents for regulators. How do you oversee a market that's this fast, this complex, this global?
Exactly. The scale, the speed, the cross-border nature, it all creates massive new challenges for ensuring market integrity. This is where international groups like IOSCO, the International Organization of Securities Commissions, become really important.
And their work was driven by?
Partly prompted by the G20 major economies, especially after things like the flash crash. There were growing concerns about stability and fairness in these rapidly evolving electronic markets.
And the goal of regulation remains the same, right?
Yeah.
Fair, efficient, transparent markets. Prevent manipulation.
The goals are the same, absolutely. But how you achieve them when trades happen in microseconds across dozens of interconnected venues, often spanning multiple countries, that's the tricky part.
So what are the key areas regulators need to focus on according to the IOSCO source?
Okay, first up is contract design. Seems basic, but it's critical, especially for physical commodities.
Why is the contract design so important?
Because if the rules of the futures contract the quality specs, the delivery locations, the timing, don't accurately match the reality of the physical market, it creates opportunities for manipulation. Someone could exploit a mismatch, maybe create an artificial squeeze at delivery.
So the contract needs to reflect how the actual stuff is traded and moved.
Precisely. Regulators need to consider market size, the commodities characteristics, supply chains, common practices, deliverable supply, cash market reliability, volatility, government rules. For physical delivery contracts, getting the details right on quality, delivery points, inspection, timing, legal enforceability. It's all crucial to make sure the futures price converges properly with the physical price at the end and to stop people from gaming the delivery process.
Okay, contract design. What's next?
Market surveillance. Having a clear and robust framework to watch what's happening. Traditionally, for physical commodities, this meant watching for anyone building up a position too large relative to the available physical supply near expiration.
But that's not enough anymore.
Not nearly enough with electronic trading. The speed and volume demand automated surveillance systems. That's called critical.
What do these systems need to do?
They need real-time monitoring to catch technical glitches, system problems, or sudden weird prices like a fat finger error, someone accidentally typing a wrong price or huge quantity, which could cause instant chaos.
So real-time eyes on the market.
Yes. And while post-trade analysis, looking at the data the next day, T+1, is still vital, intraday analysis is now essential too. Because HFT strategies, including potentially abusive ones, can play out entirely within a single trading day, even within seconds or minutes. Surveillance tech has to be fast enough to spot abusive trading on a high-frequency basis.
And a major challenge here is seeing the whole picture, right, across different markets.
Absolutely huge challenge, aggregating positions. Manipulators often operate across multiple related markets simultaneously. So regulators need a prompt and comprehensive overview of everything a participant is doing, their futures, their OTC derivatives, their positions in the actual physical commodity.
Why is that cross-market view so vital?
Because without it, you can't understand a trader's true intent or their potential impact. You might see a big futures position, but miss the related physical hoarding or OTC swap that reveals the manipulative strategy. It's essential for connecting the dots.
The sources give examples of this kind of multi-market manipulation.
They give several compelling ones, like schemes involving banging the close, manipulating futures prices right at the end of trading to benefit related options, or swaps that settle based on that closing price. That's futures plus derivatives.
Okay, what else?
Manipulating milk futures by buying up physical cheese in the spot market, knowing the price linkage. That's futures plus physical.
Wow.
Another complex one, manipulating natural gas prices at a key physical hub by simultaneously selling futures heavily on ICE and reporting false data to the companies that calculate the price indexes used for related swaps. That's futures, physical data reporting, and OTC swaps, all tangled together.
Complex.
And another example, building up a massive physical stockpile of crude oil specifically to then manipulate the related futures market price. These cases show crystal clear why regulators must have visibility across all these different market segments.
Which leads directly to needing the right powers, doesn't it? Intervention powers.
Exactly. Market authorities need effective powers to intervene quickly when markets get disorderly. And this power needs to apply to any position deemed potentially harmful, not just large ones or ones held by certain types of traders.
What kind of powers are we talking about?
Things like ordering traders not to increase positions or even ordering them to reduce positions. Setting predefined position limits before problems arise, ex-ante limits.
And other tools.
Lots of others mentioned. Imposing price movement limits, like circuit breakers, demanding extra margin, ordering positions to be liquidated or transferred, halting trading entirely, suspending or curtailing.
Also things related to physical delivery.
Yes, powers to alter delivery terms in emergencies, cancel clearly erroneous or manipulative trades, force traders to declare if they intend to make or take delivery, and demand disclosure of their related OTC or physical positions.
And the purpose of all these powers?
It's about managing chaos, preventing wild price swings, managing volatility, giving clearinghouses time to collect margin, stopping the collateral damage from errors, and just generally giving authorities breathing room to figure out what's going on and respond effectively before things completely unraveled.
Okay, so surveillance and intervention. What about enforcement? Catching and punishing wrongdoing.
Crucial. Regulators need strong powers to prohibit, investigate, and penalize market abuse. The source lists a whole catalog of abusive conduct.
Such as?
Creating artificial prices, faking trading volume, spreading false information, corners and squeezes, controlling supply to dictate price, abusing customer orders, wash trades, trading with yourself to create fake activity, colluding with others.
Also things like breaking position limits or hiding identity.
Yes, position limit violations, concealing who you are to evade limits, and misusing certain types of information like confidential exchange data or government info, which is different from typical insider trading in stocks, but still abusive.
But enforcing this in the electronic age has challenges.
Big challenges highlighted in the sources. Things like outdated laws, not having the power to get information across different markets easily, the difficulty of spotting these complex multi-market schemes, not being able to investigate non-exchange members who trade electronically, lack of resources, old record-keeping rules.
And proving manipulation can be hard.
Very hard. That's why the sources stress the need for powers to go after attempted manipulation, not just cases where the scheme fully succeeded. And because anyone can trade electronically now, regulators need powers over all participants, not just traditional exchange members.
This all seems to point back to information, doesn't it? Information sharing.
Absolutely critical. Effective surveillance and enforcement in today's linked markets depend entirely on domestic and international cooperation between regulators. You simply can't tackle multi-market abuse if authorities can't share information across borders or across different market types.
Are there mechanisms for this?
Yes. The sources mention things like bilateral agreements between exchanges, MOUs, and broader international frameworks like the IOSCO multilateral MOU. Sharing info is seen as essential whenever contracts are traded on different venues but are linked economically.
Okay, last big regulatory area mentioned, transparency and price discovery.
Right. Commodity futures markets are supposed to be price discovery markets, revealing the consensus view of future value. Regulators want to enhance information flow to make this process work better.
How? What kind of transparency?
Two main types. First, on-exchange transparency. This means the market authority should publish aggregate exposures of different classes of large traders.
Like who's holding big positions?
Sort of, like reporting the total long and short positions held by, say, commercial users, hedgers, versus non-commercials, speculators. The US CFTC's weekly commitment of traders, COT reports, are the classic example cited, along with similar reports from IC Futures Europe.
And the point of that is?
It gives the market useful insight into positioning trends, helps analysis, but does it by aggregating the data, so individual trader strategies and identities remain confidential.
Okay, and the second type of transparency?
OTC transparency. This involves promoting the reporting of over-the-counter derivatives deals to central trade repositories.
What's the benefit there?
These repositories create a central database for regulators to see what's happening in the vast OTC markets. This helps monitor systemic risk, understand exposures, and crucially investigate potential manipulation that spans both exchanges and OTC deals.
But OTC is global, right?
Exactly. Which is why the sources stress the need for international harmonization and cooperation on OTC reporting rules. Otherwise, you risk traders just moving activity to less regulated places, regulatory arbitrage, or getting tangled in conflicting requirements.
So, a massive regulatory agenda driven by the electronic revolution. Looking ahead then, based on the sources, what does the future trajectory look like?
The sources point to several continuing trends. More exchange consolidation globally and regionally as the hunt for scale and efficiency continues. Electronic trading will keep pushing out any remaining traditional structures, rapidly supplanting them.
And spreading to all assets.
Yes, the prediction is a full embrace of electronic trading across all asset classes. Fixed income bonds, even complex ones, increasingly moving electronic using algorithms.
Which means more.
More cross-asset arbitrage, accelerated by algorithms. Think models constantly trading tiny differences between an ETF and its underlying stocks or futures. This requires serious high-frequency capability.
And broader integration of systems.
Definitely. A move towards straight-through processing, seamlessly connecting everything from portfolio analysis and execution up front, through clearing and settlement, right to compliance and reporting in the back office. Integrating things like dark pools and complex algorithms becomes standard.
And a final key focus.
Operational risk management. With global interdependence, ultra-low latency speeds, and system complexity, the risk of something going wrong, an error, a cyber attack, a system failure, and causing huge disruption becomes much greater. Managing that operational risk will be paramount.
Okay, so we've traced this incredible arc from the noisy, human-driven trading pits where a trade took minutes to this silent, global, machine-driven world where trades happen in microseconds. And ICE's story really embodies that journey of strategic electronic integration.
It's a narrative of technology fundamentally reshaping markets, bringing incredible speed, efficiency, lower costs, and wider access, particularly in commodities, but spreading everywhere.
But it's not a simple story of progress, is it? As we've laid out, this leap brings huge challenges. New vulnerabilities, the potential for high-speed manipulation, and this ongoing race for regulators to keep up with technology using sophisticated surveillance, intervention, and enforcement tools fit for a global, multi-market, high-frequency environment.
It really is that dynamic tension, isn't it? Between the push for innovation and the fundamental need for oversight to maintain trust and integrity in the markets.
Which leaves us, and you, the listener, with a pretty profound question to think about, really building on everything we've discussed from these sources.
As technology keeps pushing the boundaries, making markets even faster, even more interconnected, driven by algorithms and players like ICE, what's the right balance? How do we ensure we harness all that incredible innovation while still maintaining the essential human judgment and global regulatory structures needed for fairness, stability, and ensuring markets actually serve the broad economy, not just the algorithms with the lowest latency? What does price discovery truly mean in that future?
A question that will definitely shape finance for years to come. Thanks for joining us for this deep dive.